I wanted to make this quick video because there was some breaking news for Realty Income and Spirit Realty shareholders yesterday morning. On Monday, before the market opened, Realty Income announced that they had agreed to acquire Spirit Realty, ticker symbol SRC, for roughly $9.3 billion. According to the press release on their website, the two companies have entered into a definitive merger agreement by which Realty Income will acquire Spirit in an all-stock transaction valued at an enterprise value of approximately $9.3 billion. The transaction is expected to deliver over 2.5% accretion to Realty Income's annualized adjusted funds from operation, or AFFO, per share. Additionally, no new external capital is expected to be required to finance the transaction. The merger, once completed, will result in an enterprise value of approximately $63 billion for the combined company, enhancing Realty Income's size, scale, and diversification to expand its runway for future growth. Under the terms of the merger agreement, Spirit shareholders will receive 0.762 newly issued Realty Income common shares for each Spirit common share that they own. At closing, this will result in Realty Income and Spirit shareholders owning approximately 87% and 13% respectively of the combined company. The merger is subject to customary closing conditions, including the approval of Spirit shareholders, and is expected to close during the first quarter of 2024. Additionally, from the date of the merger agreement through the closing of the transaction, Spirit may declare and pay regular quarterly cash dividends to shareholders of its common stock and to holders of its preferred stock. No approval of Realty Income shareholders will be required in connection with the merger. When this news came out, the share price of Realty Income stock fell by over 7%, which caught a lot of people's attention. The share price of Spirit Realty rose by over 8% on the other hand after the deal was made public. To answer the question, why did Realty Income stock share price fall so hard after the deal was announced, was because of how the deal is going to be financed. In order to pay for this company, Realty Income will have to issue more shares of their own stock. While that means Realty Income won't have to acquire any more debt during our high interest rate environment, it does unfortunately mean that shareholders of Realty Income are going to be diluted. Whenever new shares of a company are issued, it lowers the value of all existing shares. This is because now that more shares exist, your ownership percentage of the company as an investor goes down. I recently talked about how Realty Income has been doing this in a video I made last month, and I've criticized Realty Income for doing this. Because with interest rates being so high, REITs are already struggling in the market, and when you dilute shareholders as much as this company's been doing, it adds even more pain to shareholders like us. But ultimately, what matters is we need to figure out if this short-term pain is going to be worth it. On the company's website, they put together a little presentation that covers the transaction. For starters, Realty Income has an enterprise value of roughly $54 billion. They own roughly 13,118 commercial properties and receive $3.8 billion in rent every year. You can also see they're well diversified and claim that 91% of their total rent is resilient to economic turndowns and isolated from e-commerce pressures. Spirit Realty, on the other hand, has 2,064 properties, the majority of which are classified as defensive retail and industrial. They have a high occupancy rating of 99.8% and a WALT of 10.3 years, which is really good. If we look at what Spirit owns, you'll notice that it looks extremely familiar to Realty Income's portfolio. Some of Realty's largest property sectors include dollar stores, grocery stores, home improvement, and also convenience stores. You can see Spirit owns properties for a lot of the exact same clients, including Family Dollar, Lowe's, Circle K, and Dollar General. But Spirit also owns some industrial properties that Realty Income doesn't have much exposure to. This would include Worthington, FedEx, Whirlpool, and Ferguson, to name a few. This slide actually shows what their client and their sector allocation will become after the acquisition is completed. You can see much of what Spirit owns will simply complement what Realty Income is best at managing. Overall, Spirit Realty has a pretty good portfolio of real estate, but the company themselves have just been okay. Since Spirit Realty launched, their stock share price hasn't done too well. They've seen some growth, but you can see over time it's just fallen back down. The company had a sizable dividend cut back in 2018, going from 90 cents per share to 63 cents per share. It's pretty strange because you can see that they massively grew it just before cutting it. That seems like a really bad decision on the management side, unless there was a special one-off kind of distribution that was included in this. But I'm not sure why they would do this, because this would significantly negatively impact my confidence in their management team after they did something like this. Just looking at their AFFO, we can see it was growing for the first few years of their existence. But then what followed were 4 years of really bad performance before another big couple jumps in the last 2 years. I'd have to do a lot more digging to try to figure out what was going on, but I don't know what the management team was doing during this time. It is possible that maybe they were going through a serious transformation during the last 2 years, but it's kind of a bummer that we won't see the results of that, because maybe this could have been a much better REIT going forward. But going back to this presentation, they list 6 different benefits to the transaction. The first is immediate AFFO accretion and meaningful anticipated annual cost synergies. According to the management team, they believe investors can expect an immediate AFFO per share increase of 2.5%, which is pretty good. The second is that the attractive capital stack requires no new capital raised to fund the acquisition, which we just talked about with them issuing new shares of their stock. Thirdly, it'll complement their portfolio exposure, improving diversification and increasing investment capacity across key industries and clients. 14 of Spirit's top 20 clients overlap with tenants Realty Income already has a relationship with. Fourth, the deal will result in conservative underwriting of credit and real estate to retain upside. This just means they believe they'll be better positioned to identify future opportunities. Next, it'll preserve what they refer to as a best-in-class balance sheet that's a well-staggered combined debt maturity ladder with manageable near-term maturities. Then finally, the unparalleled combined portfolio will enhance their benefits of scale. After the deal goes through, Realty Income will become the 4th largest REIT and the 150 largest company in the S&P 500 by total enterprise value. Because of their size, they expect this to enhance their access to equity capital for their business. You can see when completed, this will move the company into 4th place among largest REITs behind Simon Property Group, Equinox, and Polaris. So in the end, what should our opinion be of this acquisition? After all, it's an additional source of pain for current investors like myself from a share price perspective. As of the making of this video, Realty Income stock is currently down over 27% for the year. And as someone who has a 5-figure investment in this stock, it's been a pretty brutal year for my portfolio because of this. First, if you're a shareholder of Spirit Realty, this deal isn't going to be too good for you, unfortunately. Your shares of SRC are going to be automatically converted into O, and based upon my math, that'll result in a dividend cut. SRC pays $2.68 per share per year in dividends. Because you'll receive 0.762 shares of O for each 1 share of SRC, if you take Realty Income's dividend of $3.00 per year and multiply it by 0.762, that comes out to a yearly dividend of $2.34. That's going to be a cut of roughly 34 cents a year per share. It's also not good because it looks like things might have been starting to turn around for Spirit Realty. Like I mentioned, after years of falling AFFO, it appeared that they were headed back in the right direction. So I guess we'll never get to see if Spirit Realty could have actually been a much greater REIT. Second, Realty Income wouldn't be doing this if they didn't see a good opportunity. Spirit owns what the company already owns for a large part of the transaction in terms of property types. With so many REITs being significantly undervalued right now, Realty Income has kept exercising their power over other REITs by acquiring them. Their AFFO is expected to reach an all-time high this year, and them acquiring Spirit will only help them continue to grow going forward. It is unfortunate that the company will have to issue more shares, but considering they got a good deal and they won't have to take out debt with high interest, it's the best option they could have gone with in my opinion. I do wish they'd slow down with the issuance of new stock, but obviously once Realty Income starts to recover as interest rates get lowered, then so will other companies and they won't be on sale anymore. The more Realty does this type of thing, the longer it'll take to see my investment recover. But I've been saying this for years that I'm in this stock for the long haul and I want it to be one of my primary sources of income when I retire. REITs are currently unfavorable in our market, but they will come back in popularity as soon as rates go back down. I'd suggest to anyone who loves dividends to buy into Realty Income now while their stock continues to be massively on sale. But with that being said, that's going to conclude today's video. If you're interested, feel free to check out my Patreon where you'll find an Excel sheet of all of my holdings updated monthly. Plus it'll give you access to our Discord channel where we discuss higher yielding types of investments. With that being said, thank you all so much for watching today's video. If you liked what you saw, then feel free to hit that like button below and click subscribe if you want to see higher yielding investing strategy content. Again, thank you all so much for watching today's video, and until next time, take care.